This is problem 6.09 from the end of chapter problems for chapter 6 from the CFA Institute textbook, Corporate Finance, A Practical Approach. And this particular question is asking about the impact of a share buyback on earnings per share. All right, so Devon Limited common shares currently sell for $40 a share, and their estimated price to earnings ratio, the PE ratio, is 32. Okay, and if they borrow money to repurchase shares at their after-tax cost of debt of 5%, so they're going to borrow money at 5% and invest that money in shares of stock that have a PE ratio of 32. What's going to happen to the earnings per share? All right, well, let's write down some of the stuff we can see here with the problem. So the share price, $40 a share, and the price over earnings is 32. So there's $32 of share price for every $1 of earnings. So I can go and back out earnings by simply taking the 40 divided by 32. Earnings are going to be $1.25. Okay, so people are willing to pay $40 for $1.25 of earnings. That makes the earnings yield, which is the inverse, the 1 over the price earnings ratio. If you're earning $1.25 on a $40 investment, that gives you an earnings yield of 3.125%. So the cost of borrowing, the after-tax cost of debt, is 5%. So in essence, what you would do is borrow money at 5% and then invest it at 3%. So that can't be good. Anytime the cost of debt, the money you raised, is higher than the rate of return on what you're earning, your earnings per share are going to decline. That's because the new money coming in isn't earning as much as the money that went before it. And I can make a quick example of that. Let's make some hypothetical numbers. Let's say the number of shares before the buyback, let's just say they had 100 million shares. And let's say that the total earnings, that's the net income of the firm. All right, so total earnings, that's the net income for the year, was 125 million bucks. And they're going to repurchase 5 million shares. Okay, so if they're going to repurchase 5 million shares, they're going to need 5 million shares times 40 bucks per share. They're going to need $200 million. So you're going to have to borrow $200 million. The cost of the borrowing, the after-tax cost of the borrowing, would be the $200 million you need to borrow to get it done times the cost of borrowing. So it's going to cost you $10 million to borrow that money back. So if the restated earnings, all right, before you did the share buyback, it was $125 million. After the buyback, you would have had to have paid the $10 million per year to borrow the money. And now the number of shares after the buyback, so we bought back 5 million of them. Now there's only 95 million shares out there. The new earnings per share would have been the 115 million, which is the original earnings before the buyback minus the $10 million a year after the buyback, divided by the number of shares that are out there now. And you can see the earnings per share actually went down. anytime you have the cost of raising the money higher than the rate that the money is currently earning, you're going to have a dip in the earnings per share. So borrowing the money to buy back the shares of stock costs you 5%. The earnings yield tells you what that money invested is actually earning. By invested, I mean invested in buying back the shares of the firm. So Devon Company would be borrowing at 5% and investing the borrowed money at 3%. It's going to have less earnings per share afterwards. So there's our answer. This is not a good idea.